Alright, we are ready to run. Perfect. Alright, good morning, guys.
Hello.
Hello, how's it going?
Good morning, guys.
Good morning.
Good morning. Good afternoon from us.
Good afternoon.
Afternoon. Yeah.
Alright, let's get started. Alright, we've had a lot happening over the weekend and even all of yesterday and all that too. So there's a lot of articles and stuff that we have to get through, but what I'm really going to do is just try to give you some summaries as we're going along the way. So yesterday we had really good, so to speak, progress, but again, just purely off of a diplomatic way. We had two of the biggest movers this week of the markets, which has been the oil de-escalation, and then also with earnings that came out. So yesterday, let's start with oil. We had the Hormuz de-escalation story. So U.S. Treasury Secretary Scott Bessent said that there could be a deal to reopen the strait that could come as soon as today or tomorrow, and crude oil fell about 6% yesterday on Tuesday because of that. So that was the narrative going into as of last night. Overnight, that has completely reversed. We have seen that the Yemen's Houthis said that they struck a Saudi oil tanker off the coast of Yanbu. Yanbu, again, is not a side detail. It is the Red Sea export port that Saudi Arabia has been using to move more than 70% of the crude that it used to ship through the Persian Gulf because Hormuz became too dangerous. So when the Houthis hit a tanker in Yanbu, they are threatening the one workaround that the Saudis had left at this point. West Texas crude oil also started to drop back down very specifically, and you'll see those numbers in these articles too, but you can pull it up on your charts as well. We trade US oil, so we saw effects there as well as oil started to continue to drop back down. And then even going into today's London session, even Asian session, price started to push back down and then coming right back down into the previous areas as yesterday too. So,
hey Sherman,
yes.
Quick thing, you're not sharing your screen today.
Oh, my bad.
Thank you.
There you go. Yeah, so it's starting to drop back down here, and we're seeing that there's an in-between the headline read that a lot of people are missing out on. And this kind of just goes back to some of the things that we have been talking about in our weekly outlook, market updates, even live sessions, which is reading in between the lines. There is a very specific detail that the market is not pricing those lost barrels. Some barrels are still getting through. The market is pricing the growing risk that Saudi Arabia, which is the world's largest holder of spare capacity, is trapped between two dangerous routes at once. Hormuz to the east, and then you have the Bab el-Mandeb, I believe, and the Red Sea to the west. So take one of those away, and the barrels, they don't disappear, but they get a lot slower, they get more expensive to insure, and even harder to root out of the Middle East. And underneath that geopolitical spike, there's still a bearish number that we're not seeing, which is the American Petroleum Institute reporting that crude inventories rose by 2.69 million barrels last week. So the market was expecting a draw of about 2 million. So physically, the supply is already built. It's there. What we have here is more of a bearish inventory print fighting a bullish war headline. So that war headline is currently winning as we're starting to see that oil is starting to drop back down bearish. But that is the tension that we're watching here, because right now we have a lot of that war premium that's starting to thin out, especially as oil is dropping back down. So The key thing on oil is yesterday the setup was like, short the bounce after a 12% collapse. Now that setup is completely gone. We're now sitting on the fourth version of the imminent deal claim in 6 weeks. The prior 3 have already failed. And every time we see that, crude has a sell-off on a diplomatic headline, the physical evidence, the tanker attacks, the shipping diversions, the insurance costs, all of it has pulled oil right back up into the 80s mark and even further up into 85. So what we're trading here is not the press conference. We're not trading the headlines. We're trading the actual physical activity and the physical vessel transits here, because the war premium is pretty much back into the price as of this morning. Any questions about that?
Nope. No question.
No.
All right. And then we have the next thing, which is the Fed officials. We had some FOMC members who were speaking today, tomorrow, and for the remainder of the week as well. So let's go back. What I'm looking for here is very specifically, I'm going to go over these here in just a little bit too, but this is another Fed official. So these Fed officials have basically come out and we're seeing a full, this is with CNBC, so we're probably going to pull that up here instead. You can pull this up on your own as well, but here basically what we're seeing is a complete divergence within the Fed officials themselves. So what we see here is the Minneapolis Fed president, which is one of the 3 officials who dissented at the July meeting, and the 3 who wanted an immediate rate hike. And this morning, he was basically talking about corporate earnings are through the roof. They're doing great. The consumer is hanging in there. The labor market is hanging in there. And he's looking at this and saying that what evidence do I have that monetary policy is particularly restrictive right now? And then the key thing that he was talking about was that he wants to see this is the time to start slowly moving up as we get more data in. So what that basically means is that this is a sitting Fed president on national television on a session morning saying that the next move should be a hike and it could start in September. Now, we also have another member, which is Paulson, the Philadelphia Fed president, who, similar to this FOMC member here, has leaned towards tighter policy. So now we have multiple regional Fed presidents publicly making the case that the policy is not restrictive enough, inflation's still not beaten. And as we saw in our live sessions and market updates earlier last week and even this week, and very specifically this week when we pulled up Bank of America's Mark Cabana's article, he was talking about you're talking to Kevin Warsh that you're talking about meeting the 2% inflation target and all that, but you haven't talked about how you're going to do it. So that's why the market this week is placing a lot more emphasis on these FOMC members and what they're saying to look at an actual game plan here. What we also saw was yesterday, let me go ahead and pull that one up. Fed William, which is the 3rd most important person after the Fed chair, vice chair, and then it's him, talking about that, he thinks that 2028 is going to be the timeline of when they're going to actually start to see inflation coming right back down into 2%. So he gave a bit more of a straightforward answer to the market, but the market is now trying to piece all the different puzzle pieces together to really figure out what is the true game plan. Williams says that the underlying measures of inflation, excluding food and energy, should ease as the conflict in the Middle East ceases to add price pressures. So in that scenario, he gave us the timeline of 2028. But he says that he's quite a bit focused on what we see in the core inflation data over the next several months. And is that consistent with the kind of run rate of inflation moving towards 2%? So you have one that's basically saying that at least right now, based off of what we have going on, he doesn't think that rates need to be hiked, versus you have two other FOMC members who are showing that, or very publicly saying so far, that we need to see those rate hikes instead. So that is the split basically right in the open right there that we see, where on one end you have the New York Fed President Williams saying that this week the policy is well positioned, inflation comes down on its own on a path that runs to 2028, which is 2 years away. And then on the other hand, you have two other members who are saying act right now or you fight the inflation at a higher cost later. So they're looking at the same data but coming to opposite conclusions, but it's happening very publicly. So that unresolved argument is exactly why the long end of the bond market is still demanding a premium, where you're looking at the US 30-year yield, and you're seeing that it has pushed back up above that 5.25%. And if you just zoom out, even going to the weekly time frame, those are levels that we haven't really come back to since 2008. We've come pretty close to it at one point in 2023, but we have not sat at the current levels since 2008. So almost 2 decades ago. That's the level that we're sitting at. So the market right now, it cannot price a Fed that is publicly arguing with itself. We need a cleaner game plan, and that's what we're trying to get from in between the lines from all these FOMC members who are talking today. And then we got ADP that came out today as well. So let's pull up that. With ADP, we got a massive drop from 95K. We're expecting a drop down to 68, but this ended up being a harder gap here. So as you can see, this is the second month that we're missing out on the previous. So far, we have been getting the narrative that the job market is very strong and all that type of stuff. And then the job numbers that just came out this morning pretty much made all that more complicated. The ADP private payrolls for July, have dropped. The market expected a little bit of a drop. That was the cushion point there. So that is still a massive gap between 68 and 95. It ended up coming out a lot lower than that. The services PMI has also dropped compared to the forecast, but pretty much similar to the previous. So we're kind of sitting at a baseline there. So now the important thing here is that this is obviously a soft print compared to the start of the year. Almost all the gains that came from one position, which was the education and health services, 36,000 jobs. The goods producing industries actually lost jobs. So the reason why this is so important for the Fed argument that, we just talked about is that one FOMC member's whole case is that the labor market is hanging in there and we can afford to hike. So this ADP number is the first crack in that. If Friday's government payrolls report, NFP, confirms this softening and it comes out a lot weaker, then it could basically take the wind out of the hawkish movements or the hawkish sentiments that we're seeing. So we're watching and paying a lot more attention to what's actually going to happen on Friday with NFP instead. Sounds good? Any questions on that?
No questions for me.
Cool. So watch the detail there, especially the wage detail on Friday, because that's the part that's going to keep the inflationary story alive. And, we saw the pay rise 7% year over year, which was the fastest in nearly a year. People who stayed in their jobs, we saw about 4.4%. When people are changing jobs, they're also commanding, 7% raises. That's what that number is telling us there. And that tells us that there's still supply constraints in part of the labor market. So it is a soft headline with a hot wage core. So that's not a clean signal, for either side here. That is the main tension that we're playing with, and we're trying to get the market to price in. So going into Friday, payrolls report, the number to watch is going to be, let's pull that up for this entire week. The number is going to be 85K. The previous was sitting at 57. If we actually end up getting a boost, then that's going to give us a good boost with hot wages. We're going to get the evidence for that hawkish movement. If it comes in soft like ADP did, then the September hike odds will start to ease out here. Another thing that I want to go over here, which is one of the biggest stories as well, is the yen intervention. So we already know that there was a yen intervention, right? And this is kind of the biggest story in the currency markets right now. But I haven't seen any commentator really fully cover this just yet. And the story here is that the United States Treasury bought Japanese yen, but the part that is the most important is that the New York Fed funded that purchase by selling euros. So let's walk through the whole chain of what basically happened here. So through late July, we already saw that USD JPY was up. It was sitting closer to the 163 areas, I believe. Yeah, like 163, 164 areas. And the hedge funds were net short yen at close to the biggest position since 2007 that we have seen. So everyone was on the same side of this trade. Then Tokyo intervened and the US Treasury intervened alongside them, buying yen. To get the dollars to buy that yen, the New York Fed sold euro holdings. And that euro selling is also why we saw euro moving across majority of the pairs as well. And we started to see that the dollar was starting to gain a lot more strength as it started to push back up bullish too. Let's come back down to the daily and find that specific movement that's happening right now as it's starting to push back up. And that is why the dollar index also fell. So it came back below the 100 mark and started to push back down, holding on to a strong resistance. The yen also against the US dollar very specifically, dropped from 164 down into 155 area in a matter of days. Right now it's sitting around 157.5 area. So the important thing here was the risk management. You know how we kept talking about stay away from the yen crosses, because sitting at these high levels, we were playing with a live intervention risk. We talked about that at the 160 level, then we talked about 161, 162, and finally it happened right when BOJ interest rates were supposed to come out. So traders who were short yen were not beaten by the market. They were beaten by two national treasuries that were acting together, with the central bank funding the operation across a third currency. So you cannot risk manage that with a technical stop. When two governments coordinate a currency operation, the price does not gap, politely around our levels. It's going to go straight through it. So even if right now you're trading any of the yen crosses, make sure that you're sizing them at the absolute minimum that you can. The dollar index needs to push back up above the $100 mark and reclaim that strength and continue to the upside before the structure even begins to repair here. Until then, the intervention risk is not any more theoretical tail risk. It has already happened twice in just the last week. Right now, there are talks about the intervention being capped, but we don't have the full confirmation of that just yet. Now let's go ahead and pull up our earnings. Any questions on these so far? Everything makes sense?
No questions for me. Yes.
Perfect.
Yes.
So now, let's go ahead and take a look at our data, what is going on. Alright, I'm going to pull up the one from last night here first. Right here. Just to give us a quick story of what has happened in the past week, what are we expecting today, all that type of stuff. So from last week, Amazon beat its earnings per share by 216%. A historic beat on AWS and advertising. Microsoft also beat by 12.1% on cloud and AI strength. Apple also beat with 6.9% off of services and iPhone. Visa also had a great beat, confirming the consumer is healthy. Now, the one that I want to focus on here that we talked about yesterday as well is Caterpillar, that came out yesterday, and that was the main Dow mover here too. Now, this one beat by 32.4%. And I feel like this one is the most underappreciated print of this entire season that we have gotten. And the reason for that is that the data center build out does not just consume chips and servers. It consumes everything, earth moving equipment, construction machinery, power infrastructure. So Caterpillar is that AI capital expenditure cycle that's showing up now in the physical economy, right? That's what we talked about yesterday. That reframes the entire AI trade narrative that we have been following so far. Microsoft and Amazon proved that AI spend converts to revenue, and obviously their stocks got rewarded for that. Meta could not show that, and it missed by nearly 14% and got dragged because of that as well. For the capex drag. But Caterpillar is a third category, a company that is now receiving the AI capital as revenue without carrying the capex risk. So institutional money has already found that, right? And then this morning, we also had a couple of more earnings that came out. Let's go ahead and pull that one up. Give me the pre-market earnings report from today. So we had more companies that came out, and we had articles about that, but instead of pulling up more articles, I just want to show you guys the earnings table here instead. But we had Disney, Uber, Shopify, and CVS. So Disney is one of the two that is going to have an impact a little bit on the market, and that is mainly because that is still showing. That's a read on consumer discretionary. And then we also have Lilly, I believe, that came out. Yeah, there we go. So Disney we had an estimate of 1.86. They ended up beating it with $2.06. So we got a nice surprise of 10.75% beat there. Revenue came down about negative 0.74%, but the year-over-year earnings per share is up 27.95%. Then we also had LLY coming out. So this one is more on the healthcare and kind of the pharma complex right there as well, which is also part of the Dow. So here we had a miss of 5.2%, and the revenue surprise beat by 12.42% here as well. So overall, we're starting to see a little bit of mixed sentiment. When the market opened up, it was pricing in the clean beats that we have gotten across the board for majority of the earnings that have come out. Now we're trying to look at the full picture. So far, we've had a lot of different pieces to the puzzle. You had, with the AI side, you had more of Amazon, you had semis, you had chip makers, you had all that stuff. And slowly we started now figuring out, like, okay, we need the physical economy picture too. So then we got Caterpillar for that. Now we're also starting to look into inflation and how it's showing up in the other parts of the economy. A couple of months ago, we already had analysis, even from, I believe it was Bank of America and JP Morgan and Goldman Sachs analysts, who were talking about how inflation, which started with just energy prices, is now slowly going to start trickling into other parts of the economy before it fully flushes out by summer of next year, if the Middle East conflict does die down in the next couple of weeks. Obviously, we haven't had that happen. We just talked about how a lot of those talks kept falling through. And that's why the market is reacting off of the headlines a little bit. But the more important thing is reading in between the lines, because that's how you're going to position yourself based off the technical level. On the technical side, you'll see a couple of spikes and the price comes right back down into consolidation. That's the reason for that. And then the other thing that we're also seeing is the full 13F positioning that is going on from the institutional side as well. So the biggest thing is, and this connects to the oil reversal, that I talked about, reading in between the lines and all that type of stuff. So Fisher Asset Management has a massive book that's running at the moment, and they have been selling a lot of their energy stocks here as well. So now if you look at what they sold, it was the ConocoPhillips, which was 1.5 billion, the Canadian Natural, which was 1.7 billion, and then they also sold Chevron for 867 million, and then they sold roughly $4 billion of energy, right? And if you look at what they're buying up, they're bought up GE for 4.3 billion. They're buying up GE Vernova for 4.2 billion. Palo Alto Networks 1.9 billion. Cisco 1.9 billion. and Nvidia 475 million. So you're starting to see the main thing here, the rotation is basically being set up weeks before any of the recent oil moves. So Fisher did not react to the headlines that were coming out. Instead, it was more about reading in between the lines. They were already well positioned ahead. They were out of energy and into industrials, defense, quality tech, and healthcare before the market really started whipping around the headlines, the war headlines here. So this cuts both ways with this morning's reversal that we're seeing, where energy sold or Fisher sold energy anticipating oil coming down. Oil bounced overnight on the Yanbu strike. So in the very short term, that position is fighting the tape this morning. But the institutional thesis is, it's not a one-day trade. It is a view that the war premium eventually comes out and the structural winners are going to be industrials and AI infrastructure. So that is not the lesson is not the Fisher is right today. The lesson is that there's a timing gap. And so on the retail side, we read the headlines and then we start reacting to that, versus you're seeing that with the institutional positioning. That already happened 3 weeks ago. So that gap right there is the entire game. That's the gap, the reading between the lines that, we're practicing here with the market updates throughout our live sessions and all that stuff. So is everything starting to make sense? What we have been talking about in the last couple of weeks with the weekly outlooks, me repeatedly saying just read in between the lines what is actually happening compared to just the headlines.
Yes.
And then the next thing, separately, we have TD Asset Management that had massive broad sells, including Apple, Microsoft, Nvidia, but that appears to be more of a rebouncing realignment of the Canadian held US exposure that we're seeing here. So I know it was pretty heavy, but this was a full weekly outlook market update, so to speak, but giving you the full picture of what reading between the lines actually does for you and the well position that we are seeing here so far. So now we can go back and do our full technical analysis. Any questions on the fundamental side?
Not
Okay.
Very complete. Thank you.
Perfect. If there's any questions, let me know. I know that was kind of heavy. But let's start off with US 30. So we are about 39 minutes into this new hourly candle. We also, let's see if there's anything else that we're missing for today. We have another FOMC member, Cook, who will be speaking. Then we have Trump, who will be speaking later today as well. And then we have another FOMC member. So we have 2 more FOMC members left. So what I'm going to do is map out the current resistance that price is tapping into at the moment, which is more of that 54,700. We had a massive push up right at the market open today. Now coming down into the daily. This is a pretty big range for this week here already. We're looking at about a 600-point range. Drop down to the 4-hour time frame. So a massive bullish run up, and then we slowed down a little bit going into London session, more of a break and retest setup, and then today right at the market open we got a massive push up that happened. Now we have this hourly candle that's going to close out here in 20 minutes, but 40 minutes into this hourly candle, it hasn't had enough direction to continue pushing to the upside or pull back down. There is still a lot of bullish momentum obviously in the market right now, and a lot of that is coming from the earnings. It's also coming from a little bit of the oil headlines, but now we're starting to see some cracks in that with the Houthis attacks that we're starting to see. But mainly right now we're seeing a lot more of the headline or the earnings optimism here instead. So what we're going to look at is if price can continue consolidating here, and if it can continue holding on to a support right down here, and then push back up bullish. We have our clean buy opportunities right above this area. We're going to set our alerts right above the resistance. Now, this is just the level that I have mapped out off of the weekly and the daily, but as we saw, that price is pretty much sitting at its own high level. So in a situation like that, when I have nothing to refer to the left, I look for a clean break and retest setup. So if this 15-minute candle can close bullish, next one creates a bottom wick, continues pushing back up, that's still not the entry candle for me. but I want to see a candle closure breaking above the previous highs and close there. Then on the following candle, as that creates a bottom wick, kind of respects this resistance as a new support and then push back up bullish, then I target with the 1-to-1, and then once that 1-to-1 is hit, then I go ahead and increase my TP and make sure that I'm managing my risk that way. This is a massive move since the market opened this week. Just this entire range, we're looking at about 1,600 points to the upside. That's a massive movement to the upside, right? Even on the daily time frame, barely bottom wicks. The current daily candle has no bottom wick. So we want to be very careful here, making sure that you don't enter buys in an exhausted move. So that's why we're waiting for candle closures. We're waiting for the bottom wicks for a continuation back up. If price does reverse back down, let's say it needs a little bit more corrective movement, and then it comes back into this consolidation, you still have a pretty good range of about 200 points, 258 points to the downside. For that to happen, you need bearish candle closures below the current support, and then the next candle gives you a break and retest, or it gives you a top wick rejection and then a continuation down, and those are your sells. So I'm going to set an alert at 54,600. Now we come over to NASDAQ, and we are bouncing off of a major weekly support, 28,200, created a top wick, rejecting right into the previous resistance levels here. This is a very clean zone to zone trade as long as we can continue to push back up. Drop down to the daily. So a massive bullish run up since Thursday, really, to the upside. This is your daily consolidation area that price has now entered into and tapped into the resistance. Drop down to the 4-hour time frame, you're starting to see consolidation. So if I see price dropping below the support area, then I have this entire tradable range here that I can take advantage of for about 400 points to the downside. If price rejects this and then continues pushing down, we're essentially looking for moves like this to the downside into this zone here. If price consolidates, breaks above, I'm still going to look for a break and retest, at least on the 30-minute time frame, and then a continuation back up bullish, and those are going to be my buy opportunities. This in between here is my no trade range. So I see that price pushed up, gave me a little support, broke the previous highs, gave me a support again, broke the previous highs a little bit, and now it's back into this little support area. So this is where we're waiting for the new hourly candle. We're trying to see which direction the current one is going to close, and if we can actually get a good movement going into the rest of the session. So set an alert above 30,000, and then below we're closer to 29,600. We have our small caps here now. So small cap, same thing, has tapped into a weekly resistance. 3,050. We have a support. 2940. Drop down to the daily. Tapped right into that resistance. Starting to pull back down here. Another zone to zone. You got the cleanest sells that are setting up at the moment. What I want to see for my full confirmation at this point, now that we have tapped into this area, is can the candle continue pushing back down bearish? If it does, you have your first entry to the downside to come back down for about 109 points, and then a continuation down, or 10 points, sorry. 10 points here. I was looking at the next number here to the right, and then a continuation down for this entire range for about 90 points to the downside. Drop down to the 1-hour time frame. We push back up. We're getting some rejections, tapping right into this area. Got about 14 minutes left for this hourly candle closure. Ideally, this one has no top wick, so I would like this candle to close below the zone. Next candle to give me a top wick into the zone, and then drop back down and continue pushing back down bearish. As that happens, I'll take advantage of that. That top wick is going to tell me where to place my stop loss, but I would like it to kind of just tap into the zone here and then drop back down instead of just right into this low level. A little bit higher, drop back down, and that is going to be the sell opportunity to the downside. I'm not setting alerts for buys here on small caps. Is anyone trading currencies here?
No.
Okay. Let's go over to gold then. gold is now breaking out of multi-week consolidation. So we had our weekly support at 3988.3. Our next resistance that price is approaching into is up top here, 4324.2. This is the multi-week consolidation that gold is breaking out of. Drop down to the daily, and you have all this consolidation. Price is finally starting to push back up bullish. I'm waiting for some clean candle closures. You got one hourly candle closure, but the next one's still no bottom wick. So given how strong this level was on the weekly and the daily time frame, what I would like to see on the 1 hour and 30-minute time frame is price to reverse a little bit down and then give me another break and retest and continue pushing back up. So this is, you have one, good. But on the hourly time frame, you don't have any bottom wicks here. I would ideally like to see a bottom wick rejection that once again respects that broken resistance as a new support for a continuation back up, or else we're risking price to reverse right back down and you end up catching a buy at the high instead of at the low. So I'm not setting any alerts on gold here. What I'm going to wait for is the new hourly candle. If it can give me a bottom wick and then continue pushing back up bullish, then we have a buy opportunity to the upside. All right, here's our silver support. Here's the resistance. It seems like silver is still sitting in a multi-week consolidation. Drop down to the daily. It's very specifically breaking out of this, and it has now, it seems like, tapped into a resistance here. So another reason why we want to be extra careful. If price actually holds on to a resistance and then pulls back down bearish, the level that I'm going to be watching is going to be right here. If price can pull back down below this, then this is your entire tradable range to the downside, from around almost 62 down to $60 to the downside. Anything in between, it's a big enough range, but I would ideally like to stay out of it given that we're tapping into weekly and a daily resistance here. If price can break above that, then we have potential buy opportunities, clean movements to come back up to the next resistance up top here. Oil, we're going to stay away from for now. All right, we have about 11 minutes left for this hourly candle closure. Any questions on the fundamentals or anything else, technical side?
Negative. No questions.
Cool. Let's wait it out here then. Go ahead and just update the YouTube side. support. Let's take a look at US 30, small caps. We also had SpaceX earnings come out. Give me what else is the SpaceX earnings that were released this week. Alright, we have breakthrough. We have 8 minutes. Let's see if we can actually get a candle closure here. Alright, 6 more minutes. Find the report real quick. It is confusing it between this here real quick. It's confusing it between the ETF, so we don't miss out on the trade here. Give it a second. Alright, we pushed down really nice here. This would be the first candle, even on the 5, to close below the zone. So what we're looking for is the next hourly to create a top wick now and continue pushing back down. So that is really good volume that we're getting in the final 5 minutes here. Retracement. US 30 has also now pushed back down. So for both of them, we're going to wait for 5 more minutes for candle closures, and then we have our trades. Alright, 4 more minutes. We've got this. Alright. So now this is SpaceX earnings that just came out. We had an earnings per share beat. Oh, surprise. Yeah. So, I mean, we're still expecting negative. So the actual was still negative. And then the revenue estimate was 6.93 billion. We ended up getting a 13.68% beat on that. So subscribers here are growing for Starlink, but revenue per user falling, showing a lot more pricing pressure. I'm trying to see if there's anything extraordinary that stands out. So it says that the earnings were objectively strong, 92% year-over-year revenue. The sell-off is driven by lockup expiry pressure, short interest remaining elevated, margin compression concerns. Let's see. So the bull case is simply on the 100 billion per year revenue target by end of year 2026 and NVIDIA exclusive AI build. If those materialize, then the current price is deeply discounted. So this is what we are looking at for SpaceX. We had massive buys on July 8th. Let's pull up QQQ. Take a look at where are we sitting on the hourly. Alright, so we are exiting out of a big sell zone for NASDAQ. Let's line that up. So right up top here where we have our 30,000 level mapped out, pretty much the same level as price continues to drop back down. We have the next buys sitting closer down here. Lines up perfectly with what we have on ours too. Let's take a look at the Dow. So these red and green zones are the institutional supply and demand zones that TrendSpider will set up for you on your chart. So we are looking at the data points here through Sidekick and having it give us the full market analysis. So just think all of this, like the buy and sell orders on the institutional side being set up onto your charts directly. No big sells for the Dow here just yet, not even on the 15. So as like your other trading charts as well, the lower the time frame, of course, the weaker the time frame it gets. So that's why I try to focus on the 1 hour, 4 hour daily levels, the green and the red zones, to see where the bigger orders are sitting. But as of right now, it doesn't seem like there's any big sells sitting for the Dow. So if there is going to be any corrective move, it's just probably going to be pure correction for a continuation, nothing with major sells. All right, here's a new hourly. The previous one closed right into the zone, kind of weak here still. Lines up good with the fact that we don't have any massive sellers in the market at the moment. What I'm looking for here is a continuation down for sells if price is to continue dropping, or price continues to establish a support here. I'm going to wait for the first 15 to close bullish, next 15 to break the previous highs, and then after that is where the entry is going to happen. So I'm going to let my alerts be right there. For NASDAQ, let's pull up QQQ again. So here, it seems like we have just exited out of a big sell. The next buy or big buys that are overlapping are sitting down here. Let's come down to the 30. And then also the 15, if there's anything else that we are missing. Not really. So we're kind of just sitting consolidation at the moment. So in either case, still you would be waiting for the previous lows here to be broken to push back down, and then look for your further buys as price bounces off of these lows to the upside, or you wait for price breakout of above this consolidation to the upside. Yeah, and you should be pretty solid there. Yeah, we have a pretty good range to to the upside if price can push back up to come right back into the red zone here. So with NASDAQ, we're just waiting. And then small caps, let's pull up IWM. That has also just exited out with the supply zone price pushing down. Let's see if there's any other buys that are sitting at closer levels. Right now it seems like there's a little bit of buy on the 15. So that's also kind of sitting in a consolidation, but if it can break the low, then we come back down into these areas here. All right, so we have our alert set. Any questions? Everything makes sense today?
No questions.
We can stay on for additional 15. I'm going to be on the charts for additional 15 anyways, so totally up to you guys. If it's a long session, then we don't have to. But I think YouTube already had a pretty long session, so we can call it a day there, but we will continue on here in Zoom.
Sounds